In this video, we're going to go over what happens when firms issue bonds in between coupon dates. In other words, what happens if a company has coupon dates of, say, January 1st and July 1st, but doesn't issue the bonds until April 17th or March 1st or some other date? What will happen? Well, what happens is the buyers pay the seller interest accrued from the last coupon date to the next coupon date. And then, of course, on the first semi-annual coupon date that takes place, the purchaser will receive a full 6 months of interest payment. Let's take a look at an example. We're told that the Franklin Company issued bonds on January 1, 2020, and that interest is payable semi-annually on July 1 and January 1. The Franklin Company uses the effective interest method for amortizing premiums and discounts, and the pertinent information is as follows. The bond's par value or face value is $1 million. The stated interest rate, or the interest rate that will determine the coupon payment, is 6%. Notice the effective interest rate, or the interest rate demanded by borrowers, is also 6%. This, of course, means the bonds will sell at par, or for $1 million. We could have figured this out using our calculator also. Setting our effective interest rate would have been the 6% divided by 2. Our number of years or periods would be 10 years times 2 or 20. The payment would be the 6% stated rate times $1 million, or $60,000 a year, $30,000 every 6 months. And of course, the face value would have been entered in for the future value of the bonds. And if you do that, you'll find that the bonds do indeed sell at par. If we were issuing these bonds on January 1, we would receive $1 million in cash from the buyer, and we would credit bonds payable for $1 million. If, on the other hand, the bonds were issued on March 1st, 2020, what would we receive from the buyer of the bonds? We would receive the full issue price. Remember, the bonds were issued at par. So we would receive the $1 million bonds payable. We will receive $10,000 in accrued interest from the buyers of the bonds, and we will credit that to interest expense. That way, when we debit interest expense on July 1st, we will zero out or reduce the interest expense for that 2-month period. Again, we calculate that by taking the $100,000, multiplying it by 6%, that would be $60,000 a year, or $500, or rather $5,000 every month. 2 months have passed, so the buyers will give us $10,000 in accrued interest. So we will receive $1,110,000. That's the clean price, that is the price without interest, plus the $10,000 in accrued interest. So on July 1st, we'll give them $30,000. They already gave us $10,000 in extra money at the time of the purchase, so they will have netted $20,000 in interest for the 4 months from March 1st to July 1st. Let's consider another example. In this case, the Franklin Company issues the same bonds, but the effective interest rate, or the rate required by investors, instead of being 6%, is 7%. Doesn't seem like a great deal. I expect a 7% return. The bonds only have a stated interest rate or a payment interest rate of 6%. I'm not interested. You're going to need to lower your price. And the company will be able to issue those bonds at a price of $928,938. Again, use your financial calculator or Excel's PV function. Our effective interest rate, that's the 7% divided by 2. It's a semi-annual bond. The term is the 10 years times 2 because it's a semi-annual bond. The payment is the face value, the $1 million, multiplied by the 6% stated interest rate, or $60,000 per year, but it's semi-annual, so the payment will be $30,000, and we enter in the bond's par value or face value for the future value. Again, remember, payment and future value fields have to have the same sign, and it will be opposite of the sign we get for the present value. So when we issue the bonds, we will debit cash for $928,938. We always credit bonds payable for the face value of $1 million, and the difference will be debited to a discount on bonds payable. What if instead the bonds were issued on April 1, 2020? So we've had 3 months go by, January, February, and March. Again, when we issue the bonds, we'll still record them with the discount as well as the bonds payable. That doesn't change. What will change is we need to record interest expense, and we will receive an additional interest payment or cash from the buyer equal to 3 months worth of interest. That accrued interest will be the $100 million times 6% times 3 over 12, or $15,000. Remember, the interest payment was going to be $30,000 every 6 months, or I should say the coupon payment will be $30,000 every 6 months, and we are halfway through that period. So we will collect an extra $15,000 in cash from the buyers of the bonds.